I think so, and it's amazing, guys. We'll go to our guests. If you bring up the VIX chart back up, I mean, with that, the VIX hit 80. It's back under 20. It looks like the skyline of Dubai with the Burj Khalifa, this huge spike, and then it comes back down. What a week it was. All right, look at that. Am I wrong? All right, if you're on the radio, too bad. All right, your first guest sees a shift in the market as mega cap growth starts to slow a little bit. So let's bring a new voice into this conversation. That is Sound Income Strategies Co-CIO Eric Beyrich, who joins us now. Eric, you heard a lot. You've been patiently listening and waiting. Want to comment on anything you heard? What's on top of your radar? What's the most important thing for you right now?
Well, I certainly don't speak as quickly as you all do, but I'll try to cover some of the highlights. I do think your focus on interest rates is everything for the markets now. When it looked like there was enough data to suggest the Fed was going to pause yet again and we weren't going to get 3 cuts this year, that's helped unravel the markets, as well as the rate hike in Japan that undid the carry trade to some degree. But there's been a shift in leadership. You can see it not only in some of the stock behavior, but also in the earnings revisions and in the movement. The big challenge with the AI stocks is that they're so damn expensive, even though they're great companies and they have great margins and great earnings growth, they don't have enough earnings growth to sustain those multiples. So as you have interest rates fall and the rally theoretically broadens out, and we've seen it not just in the stock movement, like I said, but in earnings revisions broadening, then I expect to see more of that, small cap stocks rally, more value stocks and the dividend stocks, which is what we tend to focus on, coming back. So
you're sort of echoing, Eric, a note from Citigroup out today, and I don't have it in front of me, so I'm just going to kind of go off memory on it. But the summary of it was basically that, most of the earnings growth so far had been the Mag 7, but the lag or whatever, 493, are starting to see their earnings growth grow again, and that Citigroup seemed to be, I use the term happy, I guess, that there was some broadening out of corporate earnings inside the S&P 500 that had nothing to do with the 7 stocks we talk about every day.
Well, I didn't see the Citigroup note, so I'm glad that at least somebody else agrees with me. But I'm actually looking at the data, which is just the aggregate data coming up from Bloomberg on revisions. And, it's sort of funny. Communications has had a negative revision. It's the second best performing sector. It's up over 23%. And you've seen IT revisions slow down dramatically. And that's the best performing sector. And this is within the S&P. So I just, it's just normal sentiment, if you will, when there's a lot of momentum and enthusiasm. You have all the programs talking up the big names that are working and riding the momentum. And then when they look at it and they say, oh, my God, I'm paying 60 times earnings for 20% growth, it's not worth it. Then they start looking for something else to do. And you can get some of the value names, or not necessarily in retail, but in general, for literally half the multiple of the market, and they have better earnings growth than the market averages. I think people are going to be more amenable to that than they have been riding the momentum. So that's what I think.
Let me just ask you a question. First of all, thanks for being on. I know you've looked at some retail and you're talking about things that are really expensive. And obviously the other side of that spectrum is things that are really, really cheap, which is retail, which happens on occasion. Is this one of those occasions, do you think, where even though you can paint, a not so rosy picture, that valuations already price in that not so rosy picture?
I think valuations are like a pendulum. They swing too far in both directions. So, you talked about TJ Maxx, which is like the done everything right company. They're just a fantastic company, but it's trading at 27 times earnings, and it's only supposed to grow its earnings in single digits this year. So if you shift to a lower quality, more, how shall we say, tormented story in Macy's, which is going to report, it's trading at 6 times earnings. It's got a 4% dividend, and it's got really easy comparisons, even though it's a mess, right? They're cutting stores. They're trying to refocus brands. So I think more people in a lower rate environment will say, maybe I'll pay 6 times earnings for a Macy's and sell, even though TJ is a much better quality company with a much better business model for this environment, I'll sell that great company and buy something that has more upside. So I think the consumer is economizing. We haven't seen that on the part of portfolio managers yet. They still want the houses in Greenwich and the beach house at the Hamptons. They're not yet ready to go, picking through the value